Good afternoon and happy Wednesday, everyone. It is Scott Wohlers with River Place Capital. It is Wednesday, March the 15th. I know I normally talk to you guys on Thursdays, but I'm off for the remainder of the week. But with everything that's been going on in the markets over the last week, I wanted to just take a brief moment to discuss what happened, what caused everything to fall apart last week in the equity markets, as it was a pretty down week as we gave up essentially all of our gains for the year by last Friday. If we hadn't done it by last Friday, we gave it up on Monday this week. So the S&P 500 last week was down 4.55%. And again, what caused the market to go down last week was not just Silicon Valley Bank. That's been the headline that made the news Friday and over the weekend, but the markets initially sold off last week when Chairman Jay Powell was speaking to Congress and said that the Fed would have to go higher than they originally anticipated and for longer. And the terminal rate that people believed the Fed funds would go to change from 5% to 5.25% to 6%, or 5.5% to 6%. And that sent markets downward. Then on Wednesday, we got rumblings that the Silicon Valley Bank was looking to raise some capital, looking to sell some shares. By Thursday, they were looking to do a debt raise. And by Friday this morning, we got a jobs number that was higher than expectations. But the important thing with the jobs report last Friday was the inflationary aspect of it. Average hourly earnings increased less than expectations, which you would think would be a catalyst to get the markets going higher. Because again, if those inflationary numbers come in less than expected, the Fed doesn't have to raise rates as high or for as long. And so you would have thought that would be the case, but within minutes of that, you've got the stock halted or Silicon Valley Bank. We got the news that Silicon Valley Bank needed to be rescued, that it did not have enough liquidity to support the deposits that were trying to be withdrawn from the bank. The FDIC stepped in, and you saw a severe market sell-off and cracks in the system. Now, what the Fed has been doing is the Fed has been raising interest rates to slow and dampen demand and to hopefully engage in a soft landing where they slow the environment down where inflation comes down. Well, the events of this last week are very deflationary. If banks become more restrictive and they don't lend, if people don't borrow because they're afraid of the future, if people don't repay their bills or they're not buying, then things slow down as people sit on their wallets to say, we'll just wait and see what happens. Well, when this event was caused a break in the system. So think about it, if you're trying to put pressure on an egg and it starts to crack, you don't want to keep squeezing the egg or you know you're going to break the egg. So what the Fed is doing is saying, okay, now that we have that crack, the silver lining of all of this is now that there is the potential for the Fed to raise maybe 25 or maybe even pause next week when they meet, where the expectation last week was at least 50 basis point of a rate hike. And so now you're seeing the rate hike percentage come down to possibly pausing, and this may be the very tail end of the Fed tightening cycle. What that will allow us to do is come back to fundamentals and see through things clearly and have a better perspective of where we are and where we're moving forward. So again, we had the news headlines today overnight, or broke early this morning, about Credit Suisse is a European bank being in trouble. We've gotten word as of this afternoon that the Swiss National Bank will step in to help out any liquidity needs that there needs to be. But looking at the capital at most banks and regional banks and community banks and large banks, and from everyone that I'm speaking to, they're well positioned. And the banks are well positioned. This is not a systemic risk. So at River Place, I do all of the studying of the financials and recommend and responsible for all the financial holdings we have as a firm. And so I looked at Silicon Valley Bank as a potential holding for our firm about 6-7 months ago. To put some things into perspective, banks normally trade by book value. And an average bank will trade between 1 times book value to 1.5. In really good times, it'll trade to 1 3/4 times book value, and that is about as far as banks go. Silicon Valley Bank, when I was looking at it, was trading already at 2.5 times value. Their problem was they bought long duration assets when interest rates were at the very bottom, last year and before rates started moving higher. So they bought long duration assets at the bottom to help with their margins and their spread for their short term. Okay, and so what they didn't do is they didn't hedge against rising interest rates, because as interest rates rise, that bond becomes less valuable than what you paid for it. So remember, as yields increase on bonds, the price goes down. As the price goes up, the yield goes down. So that's what's happened to all of these banks, is they're sitting on all of these, some of these banks like Silicon Valley was sitting on a lot of losses because of the bonds that they bought, and they didn't hedge those, and they were too highly levered as a bank. So that is what caused the downfall of Silicon Valley Bank. But remember, if you're a long-term investor, look past this short-term squall and this storm that you're seeing here in the markets. Look at this as a buying opportunity, and look at this as an opportunity, then understand that we're close to the end potentially of the Fed cycling. That's our belief at River Place, and we believe that we may be on to greener days ahead. So if you have questions about what's going on in the market and how to position yourself to navigate through this volatility, call us. We'd love to talk to you. You can reach us at 904-346-3460, or as always, check us out on riverplacecapital.com. Have a wonderful rest of your week, everyone. Thanks so much.